Joining us right now with his outlook for the IPO market is Doug Godine. He's head of equities at Signal Hill. That's a boutique investment bank that has launched 400 IPOs in the last decade. Doug, great to have you here with Matt and me on Street Smart. Good afternoon.
Hey, Matt. Hey, Carol. How are you guys doing? Thanks for having me back on.
We're doing pretty well. So is the IPO market. I mean, what do you make of it? Do you feel pretty comfortable in terms of what we're seeing, the new issues being brought to market?
We do. We think it's a great sign. I guess the last time you and I talked was right after we saw the jump up in new filings in March, which was the first sort of month-to-month improvement that we'd seen in over a year. They'd moved over 30 new registrations, and they've stayed above 30 for the last 3 months in a row, which we think is a really encouraging sign. I know there's a lot of discussion around there whether this is an IPO bubble or whether we're approaching sort of a bubble-like qualities or characteristics, and we don't see it that way. We think that there was if you go back in the last 12 years, there really was only sort of a sustained IPO cycle from 04 to 07, where you were doing about roughly maybe in the range of 200 deals a year. Mm-hmm. We haven't even begun to approach that level, and we're not even close to where we were back in the 99-2000 period. So while we saw an improvement in 10, we're continuing to see good, successful deals in 11. We really think we're sort of at the beginning stages, not the end of an IPO cycle.
Can we tell? I mean, there's only been a couple, as you mentioned, especially if you look at the tech area, which is where people are saying the word bubble. Really, just LinkedIn and Yandex, right? And the floats have been so small. People are saying 8 or 9%. Can you really gauge the health of the market? I mean, if you only release that much and there's no other social media IPOs out there, everybody's obviously going to drive the price up.
Yeah, that's exactly right. I think when you have these conversations, they're very sequential. It's the last thing that you just saw that seems to carry the most importance. So LinkedIn is sort of on everybody's mind, and that was internet. It was a very successful 100% first-day run-up, 10 billion market cap, and that looked and felt a lot like 2000, which I understand, but there were some circumstances. It was a much anticipated deal. There was a lot of demand for it. It's a great company. It's a really good business in a new sort of emerging social market, but they just didn't sell very much of the company. So the number of shares was very small. So the supply-demand dynamics, I think, forced the stock up. The stock will sort of find its own range, but we like LinkedIn as a company. We like the social sector, and we think there'll be more successful IPOs to come.
So, Doug, it doesn't bother you that LinkedIn is selling at something like 13 times sales and 1,231 times earnings. You're okay with that?
Yeah, I wish I owned some of it, actually. But listen, the market's going to find its valuation. They have 100 million users in their network today, and that's going to grow over time. So if you think about a market cap of maybe a contract value of, let's say, $100 per person, it's not that far off. I think also people feel like this will just simply be a bigger company. It'll carry a larger market cap. Where the market sees it right now in the very near term is always sort of tough to gauge. But I think what's exciting about it is this truly is sort of a new industry that's being formed and evolved in front of our very eyes, and this is one of the early starters in that.
Doug, I want to ask you about something that was in the Journal today, caught my attention. Andy Kessler, who's a former hedge fund guy, and he talked about the easy money in the IPO boom. It's in the Journal today. He's talking about cheap money, zero rates, QE2, whatever else we get in terms of QE, and how that's really fueling the boom. Do you buy that argument? Just quickly.
I read the article. It's a great article. Everybody should read it. He's right. There's a lot of valid points in there about the sort of misallocation of capital and the Fed being as accommodative as they have been for as long as they have been. But I don't make the equation back into the IPO cycle. Again, the numbers don't suggest that we're anywhere near some sort of bubble level. The other thing to keep in mind, that one metric that we look at at Signal Hill is the amount of capital that gets pulled out versus pulled in or pushed back in. And when I mean pulled out, I mean basically strategic M&A. When a company buys another company, that company's market cap is gone. Investors can't participate in that stock anymore. So that's capital that's been pulled out of the market. In the last 12 months, there's been $550 billion of strategig M&A just in the last 12 months.
Okay.
And in the same period, between IPOs and follow-ons, we've raised about $270 billion. Right, so we've pulled much more out than we've put back in. So that would suggest that we have some room to go. The other thing too, I think, is go ahead.
Actually, Doug, we got to run, so forgive me, but we'll definitely get some more time with you next time around. Doug Godine over at Signal Hill.
Thanks for having me on.
You bet.